Greetings from MWN.com. Dr.M.Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. Methods of pricing material issues. In order to carry the production without break, the materials are purchased in advance and kept in stores. Materials are purchased by keeping in mind of the minimum stock level and maximum stock level. The materials may be purchased from different sources. Purchase price may be different due to different time and different source of purchase. Hence, the material available in the store are at different prices. If all the materials are at one price, there is no problem in charging the price of issue of material. If materials available in the store are at different prices, then the problem is at what price the material will be issued to the production center. For example, material purchased are the 1st of January 500 units at the rate of 12 rupees per unit, the 5th of January 400 units at the rate of 10 rupees per unit, the 7th of January 600 units at the rate of 15 rupees per unit, the 15th of January 700 units at the rate of 11 rupees per unit. Suppose material issued is 600 units on the 9th of January and 350 units on the 14th of January, it is to be decided on what price the material should be charged. It depends upon the policy of the management. There are different methods for calculating issue price of materials. The following are the important methods of pricing of material issues. A. Actual cost price methods. 1. First in first out method, FIFO. 2. Last in first out method, LIFO. 3. Highest in first out method, HIFO. 4. Base stock price method. B. Average price methods. 1. Simple average price method. 2. Weighted average price method. 3. Periodic simple average price method. 4. Periodic weighted average price method. 5. Moving simple average price method. 6. Moving weighted average price method. C. Notional price methods. 1. Standard price method. 2. Inflated price method. 3. Replacement or market price method. A. Actual cost method. 1. First in first out method, FIFO. This method of pricing is based in the principle that the material purchased first or issued to the production center, first. The material issue price is charged as per the price of the first consignment. If the quantity of the first consignment is exhausted completely, then the price at which the next consignment purchased is taken into account for the issue price of material. Advantages. 1. This method is simple to understand and easy to calculate. 2. Since the actual cost of material is taken into account, the profit will not be unduly inflated or deflated. 3. The value of closing stock would be at the latest market price. Disadvantages. 1. Since same material is issued at different prices, it may complicate the calculations. 2. If the price of material is increasing, then the cost of production. It is difficult to decide the issue price if the materials are purchased at different prices at a time from different or same source. 2. Last in first out method, LIFO. In this method, the price of the last purchase is taken into account for the issue price of the material. When the quantity of last batch is exhausted completely, then the next previous purchase price is considered for the issue price. In the meantime, a new purchase is made, then the price of that purchase is considered for the issue price. When the price of recent purchase is taken into consideration, it does not mean that only the quantity of material recently purchased should be used first, for production purpose. Advantages. 1. Under this method, the current revenues are more related with the current cost. 2. This method does not result as unrealized profit or loss, since the current market price of the material is charged to find out the cost of production. 3. In the event of rising prices, the value of closing stock is less than the market price. It helps to reduce the cost of production in future. Disadvantages. 1. The closing stock will not represent the current market price. 2. When the price of material is decreasing, this method of pricing increases the cost of production in future. 3. Current revenues will not be matched with current costs if the reorder period is long and irregular. 3. Highest in first out method, HIFO. Under this method, the material purchased at the highest price will be issued first. It means that the issue price of the material is at higher price among the different prices for which material is purchased. When the quantity of material at the highest price is completely issued, then the next highest price should be charged for the material issues. For example, the material purchased on the 1st of January 500 units at the rate of 20 rupees per unit, the 4th of January 600 units at the rate of 22 rupees per unit, the 8th of January 400 units at the rate of 25 rupees per unit. Issue of material on the 6th of January 400 units, the 9th of January 500 units. The issue price is calculated as the 6th of January at the rate of 22 rupees per unit and the 9th of January at the rate of 25 rupees for 400 units and at the rate of 22 rupees for 100 units. 4. Base stock price method. Under this method, a minimum stock is kept as base stock to meet emergency situation. This stock is valued at the cost price. The remaining stock of the material is issued on the basis of first in first out method or last in first out method. The quantity of base stock depends upon the size, nature and policy of the concerns. The base stock need not be the old stock. The latest purchase is kept as base stock, but the price of the base stock material should be the price on the date of adoption of base stock method. For example, the base stock is 500 units for a company and the date of adoption of base stock is the 1st of January 2006. The purchase of material is 700 units at the rate of 30 rupees per unit on the 1st of January. The base stock of 500 units should be valued only at the rate of 30 rupees per unit throughout the period. Suppose the material purchased is 1000 units at the rate of 33 rupees per unit on the 20th of January and the issue of material is 600 units on the 5th of January and 800 units on the 22nd of January. In all situations, price of base stock should be valued at the rate of 30 rupees only. B. Average price methods. 1. Simple average price method. In this method, the average of the prices of previous purchases should be considered as the issue price of the material. If the quantity of material issued for a period exceeds the earlier purchase, then the price of that purchases should not be considered for calculating the average price. 2. Weighted average price method. Under this method, the issue price of material is calculated by dividing the total cost of available material in the store with the total quantity of material. This price should be calculated every time of purchase of material. This method fairly represents the cost of the stock and cost of issue of material. 3. Periodic simple average price method. In this method, the average purchase price of a particular period is considered as the issue price of the material. Hence, the issue price during a period for all issues should be the same. For example, if the purchase prices during the period are 12 rupees, 14 rupees and 19 rupees, then the issue price for all the issues during the period is 15 rupees per unit, 12 plus 14 plus 19 by 3. 4. Periodic weighted average price method. Under this method, the weighted average price of the purchase of the material for a period is calculated to charge the issue price for all the issues of the period. Weighted average price is the value of all the purchase of a period divided by the total quantity of material purchased during the period. 5. Moving simple average price method. This method is based in the periodic simple average price method. Under this method, the moving averages of various periodic simple average prices should be calculated to charge the material issue price for various periods. The issue price of a period will be the average price of the few previous periods and the current period price. The average price for the next period includes the price of all the previous periods and the current period price. The periods may either be a week, 2 weeks, 3 weeks, etc., or 1 month or 2 months, etc. 6. Moving weighted average price method. Under this method, material issue price is calculated by taking the average of the periodic weighted average price. This method is like the moving simple average price method. In this method, average of periodic weighted average price is calculated, instead of average of periodic simple average price. C. Notional price method. Notional price is normally a fixed price decided by the management. Hence, there may not be any difficulty in the identification of the issue price. The important types of notational price methods are as follows. 1. Standard price method. 2. Inflated price method. 3. Replacement or market price method. 1. Standard price method. Standard price is the predetermined price by taking into account of the highest and lowest prices. This price is fixed on the basis of the past and expected future prices. It helps to find out to what extent the purchase price varies with the standard price. All the issues are priced on the basis of standard price, and the difference in the actual price and standard price will be adjusted in the closing stock. 2. Inflated price method. Inflated price is the actual price. It includes carrying cost and cost of normal loss due to evaporation and shrinkage. Inflated price is calculated at the time of issue of material to production center. 3. Replacement or market price method. In this method, the issue price of a material is the market price of the material at the time of issue of material to the production center. It is the price required to replace the material due to the issue to the production center.